Okay, let's unpack this.
Let's do it.
Today, we are undertaking a deep dive into the recent financial reports for UnitedHealth Group, UNH, one of the real giants in healthcare.
Absolutely foundational. We're looking specifically at their quarterly report, the 10Q, and the earnings release for Q3 ending September 30, 2025.
Right. And our mission here, well, it's pretty clear. There's a ton of data, obviously, but we want to give you that essential shortcut.
Exactly. Navigate the huge numbers, pinpoint what's really driving performance, because honestly, this report shows a pretty stark contrast.
That's the hook, isn't it?
Yes.
This is where it gets really interesting. UNH reported total revenues of $113.2 billion for the quarter.
Which is a solid 12% jump year over year. I mean, that looks great on the surface.
Pure top-line success, you'd think. But
Yeah.
then you look just a bit lower on the income statement, and the story completely flips.
Yeah, earnings from operations, they plummeted, down 50% compared to last year.
50%. So we've got this company successfully adding revenue, growing bigger, but its profitability is just eroding.
Fast. It raises serious questions, doesn't it? It's more than just like a blip. It suggests maybe a fundamental issue in turning that massive scale into reliable profit, which is usually UNH's thing.
Okay, let's dig into that compression first. Put
Yeah.
some more context around those numbers.
Right. So Q3 2025 versus Q3 2024. As you said, total revenues, $113.2 billion, up 12%.
Okay, but the profit figures.
That's where it hits. Earnings from operations dropped from $8.7 billion last year down to just $4.3 billion this year.
A clean 50% cut. Wow.
And that just cascades right down. Net earnings for shareholders, down 61%, landed at about $2.35 billion.
Which brings a diluted EPS, earnings per share, to $2.59. I mean, that 50% drop in operations for a company this big, that's not just a tremor.
No, it's more like a structural shift, potentially, a real jolt.
So the big question is why? What caused such a sudden collapse in earning? Was it some one-off thing, a big write-down maybe?
Doesn't look like it. The source material points pretty clearly to it being structural, the main driver. A sharp, really unrelenting increase in total operating costs.
Okay. How much did they increase?
They grew 18% year over year. That significantly outpaced the 12% revenue growth.
So basically, the cost of getting and servicing that revenue just shot up.
Exactly. The revenue growth was just too expensive this quarter.
And it wasn't just like hiring more people or spending more on ads. It was the core business cost.
Primarily, yes, it's coming from the actual delivery of care.
Okay, that makes sense. So let's look closer at those costs. For an insurer, the key metric is always the MCR, right? The medical care ratio.
Absolutely. That tells you the percentage of the premium dollars they collect that are going right back out the door to pay for medical services.
And that ratio, it spiked.
Dramatically. It jumped 4.7 percentage points. Went from 85.2% in Q3 last year to 89.9% in Q3 this year.
Almost 90%. That's huge. That's got to be the core of the margin problem right there.
Yeah.
Nearly 90 cents of every premium dollar going straight to cover care.
Precisely. And the report points to sort of three main things pushing up those medical costs.
Okay, what are they?
First, just pure utilization in unit costs. People are using more care. The company specifically mentioned more notably related to physician and outpatient care.
So doctor visits, outpatient procedures.
Right. And also, the intensity of services is up and provider pricing is higher. So more care, and each bit of care is costing more.
Okay, that's one. What's next?
Second is regulatory pressure. This is where they explicitly call out external factors. Management mentioned the ongoing impact of federal funding adjustments.
You mean changes to Medicare reimbursement rates?
Yeah, those Biden-era Medicare funding reductions, as they termed it, plus the big changes to the Medicare Part D drug program from the Inflation Reduction Act, the IRA.
Ah, the IRA. How did that affect things?
Well, it changed the timing of costs within the year. It effectively shifted more of the financial risk, more of the cost burden onto the health plans themselves, and earlier in the year, too.
Got it. So utilization up, regulatory changes hitting them. What's the third factor?
It's about who they're covering. They said higher medical costs are also linked to the profile of new members.
Meaning?
Particularly people coming into value-based care arrangements, and also folks joining Medicare Advantage plans in areas where maybe other insurance plans have pulled out.
So potentially they're picking up sicker, higher-cost patients in those situations.
That seems to be the implication, yeah. Higher acuity patients driving up the average cost.
Okay, and what about other operating costs outside of direct medical care?
Right. The operating cost ratio, separate from MCR, that ticked up a bit too to 13.5%. They put that down to investments for future growth.
But there's a key point there too, isn't there? About last year's cyber attack.
Oh, yeah, good point. The report notes that the operating cost growth for the first 9 months actually looked better than it might have because they didn't have the huge costs this year associated with responding to the 2024 Change Healthcare cyber attack.
So without that comparison effect, the underlying operating cost increase might have seemed even steeper.
Exactly. It masks some of the underlying pressure.
Okay, so we know the MCR spike is the big issue, where in UNH's huge structure is this pain felt most. Let's look at the insurance side. UnitedHealthcare, UHC.
Right, UHC. And it's clearly still a growth engine. Revenue there grew 16% to $87.1 billion.
16% growth in the core insurance arm. That's impressive. What's driving that?
Mostly growth in government programs, Medicare and retirement, and community and state, which is basically Medicaid.
And they added a lot of people.
They did. Served 50.1 million people domestically. That's up nearly 800,000, 795,000 to be exact, year over year.
Wow. Where did those new members come from, mainly?
Medicare Advantage was a big one. Added 625,000 people there over the year.
Okay, in commercial plans, employers and individuals.
Commercial membership was up 200,000 overall, but, and this is important, that growth was entirely in the fee-based side. That was up 660,000.
Fee-based. Let's just quickly clarify that for everyone.
Sure. Fee-based means UHC gets paid an administrative fee, but the client, usually a big employer, takes on the actual risk for paying the medical claims.
Whereas risk-based means UHC is on the hook if medical costs go up.
Exactly. So they're adding members where they get a relatively stable but lower margin fee, while they're actually losing members or seeing attrition in the risk-based plans where they have to manage that unpredictable utilization cost themselves.
That perfectly captures the conflict, doesn't it? Huge growth, but maybe in the less profitable areas while facing cost headaches in the risk areas.
Precisely. And you see it starkly in the UHC operating margin. Despite all that growth, the margin got squeezed hard.
How badly?
It fell from a pretty healthy 5.6% in Q3 last year down to just 2.1% this quarter.
Ouch. 2.1% margin on the core insurance business. That's thin.
Very thin. And within UHC, Medicaid seems to be a particular pressure point.
Why is that?
Well, the sources mentioned the ongoing Medicaid redetermination process states checking eligibility again after the pandemic pause. That, combined with the higher care use we talked about, behavioral, pharmacy, home health, it's creating a situation where, and this is almost a direct quote, the current funding and payment rates are insufficient to meet the health needs of patients.
So the states aren't paying enough to cover the actual cost of care for Medicaid members right now.
That's what UNH is saying, yes.
Right.
And that's putting continued downward pressure on their Medicaid margins.
Okay, let's shift gears then. Let's talk about Optum, the services side. Historically, that's been the high margin part of the business, kind of the buffer.
Yeah, usually the counterbalance. Overall, Optum revenue grew a solid 8% to $69.2 billion, so still growing.
But the margin story there too.
Same pressure. Optum's overall operating margin dropped quite a bit, from 7.0% last year down to 3.6% this year.
So the pressure is company-wide. But within Optum, it's not uniform, is it? It's really different depending on the division.
Exactly. It's truly a tale of two, maybe even three, operations here. Let's start with Optum Rx, the pharmacy benefit manager, the PBM.
Okay, Optum Rx, how do they do?
They were the big revenue driver within Optum. Revenue up 16%, hitting $39.7 billion. That was driven by getting new clients and more business from existing ones.
Sounds good. Prescription volume up.
Yep. Adjusted scripts were 414 million in the quarter, up a bit from 407 million last year.
So strong growth there. But what about the margins? You said the overall Optum margin was down.
Right. Optum Rx's operating margin also dipped, though not as dramatically. Went from 4.85% down to 3.9%.
Why the decrease there?
The reason they gave is really interesting. It's due to mix effects. Specifically, higher cost drugs driving higher revenue growth, but with lower margins.
So they're selling more expensive drugs, which boosts revenue, but they actually keep a smaller percentage of that revenue as profit.
Precisely. Success in driving revenue through costly specialty drugs is actually pinching their margin percentage.
Okay, that's Optum Rx. Then there's Optum Health. This is the division that actually provides care, runs clinics, employs doctors, right?
Yes, the value-based care delivery arm. And honestly, this is probably the most shocking part of the entire report.
What happened there?
Revenue was flat year over year, around $25.9 billion. Okay, no growth, not great, but not terrible. But The earnings?
Go on.
Operating earnings basically vaporized. They fell from $2.2 billion in Q3 last year to just $255 million this Q3.
Wait, from 2.2 billion down to 255 million.
Billion down to million, yes.
That's incredible. What does that do to the margin?
It cratered. The operating margin for Optum Health went from 8.3% last year, all the way down to just 1.0%.
1%. Wow.
That number, 1.0%, is probably the single most important figure to understand here. That massive collapse in Optum Health's profit, it directly mirrors the pain we saw in UHC's insurance margins.
It confirms it's a systemic issue, doesn't it? The rising cost of care, the utilization spike.
Exactly. It shows that even in their integrated care delivery arm, where they theoretically have the most control over costs, where they're supposed to be bending the cost curve through value-based care, even there, the costs are dramatically outpacing what they're getting paid.
That really does raise fundamental questions about the whole value-based care model. If the cost trends stay this high, if the part designed to manage costs is only making a 1% margin, where do you go from there?
It's a critical question. And quickly, the third piece is Optum Insight, the tech and data arm.
How'd they do?
Flat revenue, slightly lower earnings. They cited investments for future growth. The interesting thing there is the potential pipeline. They're sitting on a huge contract backlog, about $32.1 billion. So potential future growth is locked in.
Okay, so despite that really brutal Q3 earnings picture, particularly in Optum Health, how does the company look financially overall? Liquidity, balance sheet?
Still quite robust, actually, which is critical, as you said, for a financial services type company. Cash flow from operations in Q3 was strong, $5.9 billion.
And that's much higher than their net income, right?
Yeah, about 2.3 times net income. That shows good working capital management, quality earnings. And for the first 9 months of the year, operating cash flow was $18.6 billion. So cash generation is still very strong.
And the balance sheet? Debt levels?
Pretty stable. The debt-to-capital ratio held steady at 44.1%. No red flags there.
And they're still returning cash to shareholders, even with these profit pressures.
Seems so. Looking at capital allocation, they bought back 12.1 million shares so far this year, year-to-date 2025. Average price around $455.
And the dividend?
They actually increased it back in June 2025, boosted the quarterly payout to an annual rate of $8.84 per share.
Buying back shares, raising the dividend, those feel like confident moves in the face of such a tough quarter for earnings.
They do. And management sort of backed that up by raising their full year 2025 outlook for adjusted net earnings. They're now guiding to at least $16.25 per share.
So they must believe that either this Q3 utilization spike won't repeat at that intensity, or maybe they've already adjusted pricing, or have other levers to pull for a stronger Q4.
That seems to be the message they're sending, yes. Confidence in hitting the revised, slightly higher full-year number.
Okay. Any other operational updates?
Just one quick note. They mentioned their planned sale of the remaining South American operations. That divestiture is now expected to close later than they originally thought, pushed back to the second half of 2026.
So a bit more complexity to manage for a bit longer there.
Adds a layer.
Yeah. All right. So let's try and pull this all together. What's the main story here? #headed outro.
Well, this deep dive, I think, it really lays out a clear narrative. UNH is undeniably the king of scale. They are incredibly successful at growing their customer base, especially in those big government programs like Medicare Advantage.
Huge reach, huge revenues.
Exactly. But that growth is hitting a major wall right now. It's being challenged acutely and structurally by this sort of perfect storm. Rising medical costs, higher utilization, and ongoing regulatory and reimbursement pressures.
And that structural conflict, that's the absolute core tension in this report, isn't it? The profit contraction we saw across both UHC, the insurance side, and critically Optum Health, the care delivery side.
Right. It's proof that the actual cost of medical care they're experiencing is just radically outpacing the assumptions they built into their plan pricing and reimbursement models.
And UNH themselves said these higher costs and utilization trends might continue, which leads to a pretty big question for you, the listener, thinking about the future affordability of the whole health system.
Yeah, I mean, what happens next? If these trends are structural, if medical costs really do require MCRs to stay up near 90% long-term, what gives?
Does that mean consumer benefits have to get cut back? Do premiums just keep rising sharply? Or does government reimbursement, especially for Medicare and Medicaid, have to increase significantly to match the reality of care costs?
Something has to adjust, right? If the underlying cost structure has permanently shifted higher, the financial model has to adapt somehow.
And the whole sector is watching UNH, you can be sure of that. How do they reprice and re-strategize for a world where costs seem to be persistently outpacing even their massive scale?
That really is the ultimate test for them, and maybe for the industry.
Okay. This has been your deep dive into the numbers. We hope this knowledge helps you stay well informed.